Hello, everyone, and welcome to my Prosperity Squad. As promised, this week we'll be talking about ETFs or Exchange Traded Funds. An Exchange Traded Fund is anything that you can buy in a single trade that will give you exposure to one or to more than one asset. So you can buy for instance, the ASX 200 has an ETF, so you can buy every share in the top 200 shares in Australia in a single trade, and that will give you exposure to the biggest 200 shares that are regularly traded on the Australian market. So I'll get right into it, and I'll show you my presentation. Exchange Traded Funds. So Exchange Traded Funds are a very effective way of purchasing assets, especially for those beginning, because it means that you can diversify your portfolio quite quickly. Let's go into the different kinds of exchange traded funds first, just to show you what's available out there. I think we're all the way at the end. I think if I just skip back here, start. So here we have the two kinds of exchange traded funds. So an exchange traded fund is essentially any fund managed by something that is available through the listed market. Okay, now this seems a bit confusing, but you can have active and passive ETFs. So an active ETF is unconstrained. It doesn't track an index. It's managed by a professional portfolio manager who decides which stocks he's going to buy when and when he's going to sell and when he's going to, why he's holding, and he'll often rely on the fact that the market is inefficient. So he thinks that prices are too low, so he buys, and then he thinks prices are too high, so he sells. So the profit is tied to the skill of the manager. And in active funds, they generally, because of the amount of effort required to maintain that portfolio, there is high fees associated, and they can be as high as 3% per annum, or even have things like performance fees. So if they perform exceptionally well, they'll get additional benefits and things like that. Now, active funds can incorporate passive elements, so they'll have maybe an active fund that's all ETFs, index-linked ETFs, but they'll choose and pick and select like sectors where they think there's additional value to be made. Now, active strategies tend to outperform passive strategies in downturns. That's because that the managers tends to buy things perceived as highly valuable, and they tend to fall and underpriced, and they'll be part of their portfolio, and they tend to outperform the general market in times of downturn, because the passive funds are all weighted towards the larger end of the market in terms of like large stocks, and the big companies that have large valuations tend to fall more in a time of downturn than the smaller selected niche companies that have a unique advantage. Now, passive ETFs, they track indexes. So an index is a bundle of shares that's designed to measure the performance of any certain market. For instance, the US index. So they have the top 500 called the S&P 500, which is one of the most popular ETFs in the whole world. And you can get funds, passive funds, that all they do is they automate, rebalance your portfolio or a portfolio to that index. So it will have the largest stock will be the largest stock in the S&P 500, or Amazon and Apple. And they will be your largest holdings if you were buying the 500, and if you're in Australia, it would be things like Commonwealth Bank, which is one of our largest funds, BHP, Rio Tinto, all those kind of things. Passive funds rely on the market efficiency principle, which is the opposite. They think that the market is very efficient at predicting what price something should be worth. And if that's the case, there's nothing to be gained by picking the lows and picking the highs and all that. That kind of thing is against the market efficiency. So they're saying that the price is correct, and there's money to be made by buying and holding long term onto a big bundle of assets. Now, they are very very low cost because they're automated via robots and algorithms, automated AI trading. So they'll see we need to buy this many shares of this company to get the index back to weighting. And if there's, say, new money gets issued, they issue a lot of new stock, they have to buy an equal weight of 200, 500, 800 stocks, and they do that automatically through algorithms and robots. And that means that you're constantly buying and you're constantly selling as the weightings of portfolios get lower. For instance, a certain stock that underperforms and goes down will, at the next rebalance, which happens usually quarterly, that stock will be sold down by the fund and they will buy things that have gone up. And that means that you're always benefiting from momentum. You're getting a higher percentage of things that are going up and a lower percentage of things that are going down. So that's essentially the difference between active and passive ETFs. So there's mainly just a fee difference and a mentality difference between the two styles. Let me move on now. So what is the big deal? What is this ETF craze that I've been hearing about? So ETFs have pretty much taken over the world. Their first product was launched in 1993, and now in Australia alone, there's $36.2 billion invested into the ETF market. That's a lot of money being managed in this way. And it's not only picked up by individual traders, it's also picked up by institutions. Things like your super funds will buy these kind of ETFs, and they will hold them for a long time, and then you will get exposure to this through your super fund, like Australian Super or wherever you are. Now, globally, the market is now $4 trillion US. And if I zoom in here, and it's growing by 24% per annum on average since every year from 2003 to 2016. This is an incredible growth rate. And if we zoom in a little bit more, you can see the blue is the amount of in the US market, management of money in the US market. So it's obviously dominated internationally. The US market is a very huge listed market, one of the biggest listed markets in the world. Maybe 40% of their economy is on the listed market, which is very high for an international standard, which is why USA tends to make up a very significant amount of the investment capital in the world. So that's all tied up in the S&P 500, the NASDAQ, Dow Jones, all those indexes that you can buy. And there's ETFs that track each of them. So yeah, it's a huge trend. It's very popular, and it has proved to be a very effective way of investing, as ETFs have done exceptionally well over the last 8 to 10 years. It's because there's been a very historically low level of volatility, which means that things have just been consistently ticking up for a very long time. Whether that will continue or not is yet to be determined. So even though a strategy could be very effective, it doesn't mean it's always going to be very effective. But there are some fundamental things that are great about ETFs. Just quickly on this screen, you can see Global State Street Advisors, BlackRock, iShares, and Vanguard. These are the big three, especially State Street, BlackRock, and Vanguard are the big three ETF providers in the world. Vanguard is the very largest, and iShares by BlackRock, that's a local to Australia. iShares is the Australian arm of BlackRock. And just so you are aware that those are ones that you can look up, and if you wanted to pick your own ETFs and things like that, there's a lot of information on their websites as well that you can look at. Let's go into the benefits of index-linked ETFs. So when I say index-linked ETFs, I mean the passive type, the ones that we talked about earlier as passive. Now, these type of ETFs are very low cost, so it's cheap to buy and cheap to keep. So they don't charge you many management fees on an ongoing basis. I would say some of them are as low as like 0.2%, or even lower. And some go up as high as 0.86 to 1%. If you're getting charged any more than 1% on an index-linked ETF, you should be a little wary because that sounds expensive. Exposure to between 100 to 1,000 stocks in a single trade. So lots of ETFs have less than 100. There's also many with even more than 1,000 stocks in one trade. So it is a very broad range of how many assets that you can get in a single trade. So there's some like the emerging markets ETF that we're going to talk about a little later has close to 1,000 stocks in a single trade, and you're only paying like $20 for the right to get that. So it's very efficient way of investing, especially if you're just starting out and you only have one asset. You want that asset to be instantly diversified. You don't want to just have exposure to one thing, because if that industry happens to take a tumble, you don't want your whole portfolio to take a tumble. So you need to be spread out into a bunch of different asset classes as well. We'll talk a bit more about that in a second. So this is the other thing I was saying. It allows investors to target specific classes of assets broadly within their existing portfolio. So if you have a portfolio that's heavily invested into the mining industry, or potentially you've got a lot of healthcare stocks and you want something that's less volatile than those things, and you're like, you know what, I need some fixed interest. It's something that's very stable, especially in downturns, and I want that to be instantly diversified. I don't have much experience. Say if you don't have much experience investing in fixed interest, you can buy something like a fixed interest ETF, Exchange Traded Fund, that will track the fixed interest index, and you'll get exposure to hundreds of fixed income assets. And that can be a great way of sort of getting the exposure to assets that you don't have access to. So let's go back into benefits again. So that's the highly diverse. So there's a lot of different index funds index linked ETFs that you can get. For instance, it's quite difficult to buy US stocks directly in Australia unless you've got international trading accounts, which are somewhat difficult to set up. But if you are buying an index linked ETF, you can get exposure to the US market, you can get exposure to the Chinese market or the Indian market, whatever you like. Through a single trade on a local market. So that's something that you don't really get if you're buying direct equity. You're going to find it quite difficult to continuously buy from different exchanges. So that's a good thing about index-linked ETFs. Let's move on. So strategies. You have to be wary. Like, even though something is instantly diversified and you get hundreds of stocks, they could all be very correlated to each other. So for instance, if you were buying there's a specific ETF in Australia called the mining and materials ETF. And if you're buying that and the mining industry takes a tumble, you're still not diversified. All of those assets are going to fall. Potentially some more than others. For instance, if iron ore is having a hard time, you'll still get benefits from having oil miners and things like that, drillers. But it's important that you're not getting overexposed to a single market in your trading. So that's why it's still good to select a basket, which I'm going to talk to you about today. So if you've got one ETF, that's not as good as having two very different ETFs. Maybe one in the emerging market, one in the Australian market, one in the US market. Then you've got three different pillars of exposure that aren't very correlated to each other. You can also get things like Australian commercial property ETFs, and that commercial property isn't very correlated to the international stock market. So it could be something like a hedge. It stops you from losing money in an extreme period of downturn. You've got assets that are protected against that kind of thing. For instance, when the market generally goes down, gold tends to go up. So if you've got a fund that's very linked to the market in general going up, you buy a gold ETF and you've got some protection against the market going down too, so stop you from losing too much money. That's what I'm saying is that holding an index-linked ETF isn't a free pass to long-term positive returns. You have to still do your own research, get advice, and don't jump in with both feet. Some ETFs are very risky. They have things in them that aren't quite on first glance easy to understand. So you can have things like ETFs that are just full of options, which is is a derivative product and it increases the risk of that underlying asset going down. It will tend to, because of leverage, it will tend to fall further than the rest of the market, and that's in situations that hurt that stock. So it's just quite difficult to entirely scope out the advice to scope out an ETF unless you know what you're doing. Um, and you can do things like accidentally overlapping your exposures. So you're buying the ASX 200 and you're buying the materials and mining index, then you've got exposure to mining through the 200, and you've got exposure and more exposure to mining through the mining ETF. So you can overlap your exposures and be hurt, like double hurt, especially if those markets tend to fall down. You also have to watch out for unfavorable exchange rates. For instance, the Australian dollar is very weak against the US dollar right now. So if you are buying into US dollar denominated assets, you could be hurt if the exchange rate comes back the other way, the Australian dollar strengthens due to our exports being strong, etc., etc. And so exchange rates unfavorably unfavorably buying with the exchange rate could hurt you. So there's something to watch out for, and that's why I'm saying that advice is still important, and you can use ETFs, and you can build a bundle of you can get advice to build a bundle of ETFs quite quickly, and then hold those for as long as you want them to be. You only need to get the advice once. I would still recommend regular reviews, but yeah, if you do just want to buy and hold, it can be done. And the longer you hold it, generally the better the chances that your returns are going to be positive. So let's go right into a case study. So IEM is the iShares Emerging Markets ETF. Now this index linked ETF is tied to the MSCI Emerging Markets Index. This is an index that tracks over 15 emerging market countries. So emerging market countries are countries that were previously developing countries, as in like India, China, Taiwan, South Korea, Thailand, etc., etc. You'll see in a second the different countries that make up this index is and they generally have the highest growth rate of any market. So you're only paying $6.90 for every $1,000 invested per year, and you get exposure to, in a single trade, to at the moment 976 different securities from over 15 countries. So it's a very broad ETF, and you've got exposure to things like Samsung, Alibaba, Tencent, Baidu, which is an Indian company, etc., etc. Now, emerging markets right now is a bit of tension due to trade war between the United States and China. So there is a little concern that that market is going to be hit really hard, and that's why, in my opinion, the price is quite low and presents a good opportunity to buy. But do your own research, I'd say. Here is the breakdown of countries that are involved in the MSCI Emerging Markets Index, and we've got 31% of the fund is in China, 14.68 South Korea, 12.11 Taiwan, nearly 10% in India. We've also got South Africa, Brazil, Russia, Mexico, Malaysia, Thailand, and the rest of the countries make up the other 10%. So there's a lot of different countries. You're getting exposure to a lot of different places and a lot of different currencies. So you are getting that breadth of exposure to many different industries, a lot of manufacturing, a lot of product development, especially. There's also many tech companies in China that thrive because of the Great Firewall in China that blocks anyone using Apple and Google, so they have to make their own tech products. And they've been making a lot of money in China because its population is very large. So this is a country breakdown, and you're also exposed to a range of different sectors. So IT makes up 27.46% of the index. You're also getting 22.88% of your money invested in financials. They're usually bank stocks or insurance companies and things like that. Also consumer discretionary, so that's like things like handbags and retail, cars, anything that's like a luxury item essentially. And then you've also got materials, so that's mining, and especially Brazil is very large in that area. Energy, things like oil, gas, consumer staples, paper staples, things that just day-to-day use, toilet paper. So there's a lot of different sectors that you're getting exposure to, and that's what I mean about the broad nature of ETFs, that you are getting your money spread out for you instantaneously, so you don't have to do it. Um, let's move on because there's a little bit more I wanted to talk about with this stock, and I'm aware I've gone quite a long time. So emerging market countries are the fastest growing in the world, and this, in my opinion, is due to their massive population, large proportion of which are coming out of impoverished times and now only seeing and receiving livable wages. So wage growth there is very high per capita, so per person. Consumption continues to build, and also the Chinese government is embarking on a really large infrastructure initiative called the One Belt, One Road initiative, which is building uh, high-speed rail networks in overseas countries all the way from Africa to Japan and Russia. They want to try and create a quicker way for them to distribute their goods throughout the world, as well as creating jobs, earning money from these countries, and developing closer relationships with their neighbors. So it's a very, really, really big infrastructure project. And it's going to create a lot of jobs, a lot of consumption, and a lot of profit for those companies that make up those indexes. So all those companies they're going to get jobs, they're going to get new contracts. The Chinese government will tend to prefer giving the contracts to Chinese companies over local companies, just because that's the way they do business. So it's very, very good growth aspect of it. The other thing I'd like to point out is something called price to earnings ratio. And a PE ratio is essentially how many times, how many years would that company have to earn their profit in order to justify the price. So if a stock is trading at 10 times earnings and it earns $10 million a year, um, that means that the price of all the stocks, all the shares on issue together would be worth $100 million. That's essentially it on a simple basis. Now, over time, you can see the MSCI index, which is the emerging markets index, was in blue, and it previously became more expensive on a price earnings rate ratio than the US market in 2008, even though 2008 market was very overinflated in the United States. So China was even more inflated. And now what's happened is that the US market has become steadily and steadily more expensive um, comparable to the emerging market countries, that now it's a crazy rate of difference. So it's right around 30 times earnings for the US 500 index, and right down at 14 and a half is around about times earnings for emerging market countries. So this is a very strong indicator that that the emerging market countries are actually cheaper than US equivalents, which is really positive for those countries. It means that either earnings has gone up or price hasn't come up far enough um, to justify the increase in earnings. So it's become cheaper, essentially, on a relative basis. So that's it. I know I'm aware that it took a long time, so thanks for staying with me, those of you who did. And I hope this has been helpful for anyone. Putting together a bundle of exchange traded funds is something that's relatively easy and can be managed by your advisor. So please do get advice if you wanted to know about how to put together a portfolio like this. Um, Getting someone to manage a portfolio of ETFs isn't such a bad idea, because especially if you're a complete novice, because it's taking the temptation away from you to get out at poor times and get in at poor times. Timing the market is very important, even with exchange traded funds. You don't want to be buying into something that's widely pegged to go down and has stayed up. So for instance, if it was me, I wouldn't be buying an S&P 500 index right about now, just because, in my opinion, the U.S. market is very high at the moment. And yeah, so that kind of thing. Thanks for staying with me, everyone, and happy Friday to you all, and I hope you have a great long weekend. So thank you. Appreciate it. Take care, guys.